So it's been some days already that the earnings season has started, meaning companies are releasing how much money they earned during the last quarter. And if you've been watching my channel for a while, you know that I really much like trading this type of earnings. And in this video, I wanted to show you a bit the results that I got so far. I'm going to show you trade by trade, and I'm going to go into TestyWorks and show you my broker statement so you can see by yourself what are the type of trades that I like to take, on which stocks, and I'm going to try to explain my thought process at the same time. But if you'd like to see more videos like this one where I review some of my trades, for example, and you like to see more videos like this one, then just click like and subscribe to my channel. That's the best way to let me know me after that in my analytics that you actually like this type of videos and you like to see more of them. So quick reminder for those who maybe wouldn't know what earnings are. Every quarter, publicly traded companies release how much money they earned during the last fiscal quarter. And that creates a lot of opportunities in terms of options trading. And if you don't know what I'm talking about in terms of theory and what is happening during those earnings, I made a video on the subject, and if you'd like to watch it, I'll put the link of that video in the description of this video. The strategy that I like to use is called the short strangle. It's by selling a call and selling a put at the same time. That creates a trade where you bet that the stock is actually going to stay within a profit zone. So if we go, for example, in TestyWorks, right now I'm in the TestyWorks platform, and if I, for example, go on the SPY, I'm not going to focus too much on, for example, why I choose the stock. It's just to show you the strategy. And I'm on the SPY, as you can see at the top. Right there, you can see that I'm actually in the option chain for the May 21, 2021 expiration. And as I said, I sell short strangles. And a short strangle is composed of selling a call and selling a put at the same time. So for example, here in this SPY expiration, if I was, for example, selling a put, as you can see, I'm in the put column. And then after that, I go down to sell another at the money call. Then you can see if I after that go into the profit graph. So this type of graph is very, very useful in terms of analysis because it allows you to see if you're going to make money at expiration. So this graph shows the profit or loss at expiration, meaning that, for example, if the trade stays within my call and my put, if it stays between the 397 put and the 435 call, then I'm going to make a profit at expiration. If it goes out of that profit zone, I'm going to lose money. And that's why you have those red zones outside of my strikes, and within my strikes you have this green zone, because it means that at expiration I'm going to make money if the stock stays within that profit zone. So this is really the basics on the short strangle, and as I said, I've made a video on the subject on how I trade earnings exactly with all my process, all my methodology, and if you'd like to watch it, as I said, the link is in the description of this video. So without waiting, let's get into my brokerage activity and see which trades I've been taking using the short strangle strategy. So we are in my activity tab right now, and as you can see, that's basically where I have all of my trades. Everything that I do basically in my account, they're going to be showed in this activity tab. And I'm going to present you trade by trade, and I'm going to try to explain what you're seeing so it's completely clear. So the first trade that I'd like to show you is on Delta Airlines. So I'm going to put that within this yellow rectangle, as you can see. So as you can see, there's the symbol, the stock ticker DAL, that's for Delta Airlines. You can see that I received a credit of 74 cents and I sold it. So here, as you can see, it's 8:26 p.m. because I'm located in London, so the stock market closes at 9 p.m. So as you can see, when selling that short strangle on Delta Airlines, I collected a credit of 74 cents. And as you can see, I sold it around 8:26 p.m. So I sell it quite late because I'm located in London. So in London, the stock market closes around 9 p.m. And I like to do that usually. I like to sell short strangles, especially for earnings, just before the close, basically, because that's where the implied volatility is, at least in theory, at its highest. And so that's where the options are at their most expensive, just before earnings. And you can exactly see the details of what I've been selling in terms of calls and puts. So you see that I've sold the 47 put and I've sold the 50 call. So as I said, it's a short strangle. You sell a call and a put at the same time. It's creating a short strangle. If the stock stays within that zone after earnings, then I'm going to earn money. What is quite interesting also to note is that all of those trades, all of those earning trades are done with the closest expiration. That's where really there's going to be this IV crush that I talk a lot in my other video where I show how I trade earnings. And that's really the best way, in my opinion, to benefit from this IV crush, by going for the closest expiration. So after I sold that short strangle, it was on the 14th 15th of April at around 8:26 p.m., you can see that I have another transaction for Delta Airlines the next day on the 15th of April, so literally the next day at 2:30 p.m. So that's when the stock market, the US stock market, opens in the UK. And what happened with that transaction, I basically got like the opposite transaction that I paid for 37 cents of debit. What does that mean? Well, it means that I closed my trade for a profit of 37 cents. So I made 50% profit on that trade. And just with that trade, there are a couple things that you could maybe wonder. First one is, as you can see, I closed my trade directly at opening. And the reason for that is that I have what we call GTC orders, good till cancel orders. And those GTC orders is basically a complicated name to say that it's just a take profit order. I'm sure that you're familiar with take profits, meaning that if you reach a certain level, then the broker is going to execute automatically your trade. Well, that's what it is. That explains why I directly got my order filled at 2:30 p.m. because directly when the stock market opened, my trade got filled for that price for 37 cents of debit, making me a profit of 50% on that trade. Now that you understand a bit how it works, this activity tab, and you understand a bit my methodology, meaning that I'm going to sell short strangles right before the close, the day before earnings, and I'm going to hopefully at least buy back my short strangle at a lower cost so I can make a profit on the trade. I'm going to go over the next trades. So for example, you can see that I have done the exact same thing on C. I've sold the 70.5 put and I've sold the 75 call, as you can see. Here, I collected a credit of 75 cents, so you see that it was almost exactly the same credit that I collected for C compared to what I collected for Delta Airlines. And what happened is that you can see above, and let me put it in that rectangle, you see that the next day, 2 minutes, you see that here it's at 2:32 p.m. 2 minutes after opening, my trade got filled for a small profit. So what happened here is I collected 75 cents of credit, so I sold those options and then I bought them back for 66 cents of debit. So it's like a $10 gain, so it was really not much. I mean, I basically scratched the profits here. But basically, what does that mean? It means that the stock didn't stay exactly within my profit zone. And to show you a visual explanation of what happened for Citigroup, so as you can see, the earnings were on the 15th, and I think it was exactly that day. So you can see that the day of earnings, the stock went from like $71 to $70, something like this. Basically, what it means is that the stock started going away from my profit zone, because if the stock stays really in the middle of my profit zone, that's where I'm going to have the biggest profit. And it started going away of my profit zone, almost challenging my put. And in that case, I was barely in a profit here. And if we go back into my activity tab, I had taken another trade on Schwab, and basically almost the same thing happened. You see that I scratched it. You see that I really scratched that profit here. So basically the start of that earnings season, so I had taken 3 trades. The 3 trades were winning trades, but they were not like big winners. As you can see, I made a 50% profit on Delta Airlines, which was good, which is the normal thing. And then after that, I got some small profits on Citigroup and Schwab. So what happened after? Well, after that, I started taking another trade on Morgan Stanley. So as you can see, I sold a short strangle on Morgan Stanley. I collected 66 cents of credit, and as you can see, once again, it was at 8:43 p.m. So once again, just before the market closes. Then after that, the next day, I bought back my short strangle for 17 cents of debit. And in that case, I made quite a good profit on Morgan Stanley. If you sell something at 66 cents and you buy it back at 17 cents, then you're going to almost make a profit of 50 cents here. So this is quite nice. And this usually happens when the stock really almost doesn't move during earnings and you have a big IV crush. And if the stock stay really in the middle of my short strangle, it's really where I'm going to make usually the biggest profits. And to be precise, I think that trade was at 85% profit. So I really managed to get a good profit on that trade. After that, I also managed to take some trades on Bank of New York Mellon. And as you can see, I collected 65 cents of credit once again, and I bought back my strangle for 48 cents of debit. So once again, quite a small profit here, but you get the thing now. But that's just how it works. Sometimes you're going to have like 10 trades in a row that are complete winners. You really make some good money on them, and some trades that are not going to work at all, and that's just how it is. You just need to work the probabilities and just keep doing the same thing. Because here's the thing, and that's, I feel, something that is quite often misunderstood about the stock market. This is really probabilities. This is not like something, where you look into the company and you see if, for example, they had a good fiscal quarter, and then you're going to think, what is the stock going to do? No, not at all. It's really based on math and probabilities. And if you follow something that are basically based on probabilities, you know that you need to have and to keep repeating the same thing over and over so you can actually see the probabilities manifest themselves in real life. Like, that's how it works. And after that, I'm going to show you all of the trades that I've taken, like I think it was since last year, if I'm not mistaken. And you're going to see that first, I don't necessarily take many earning trades, but when you just follow probabilities, it's very interesting to see the results. And the last earning trade that I've been taking so far, after that there'll be more that are going to come in the next weeks, but so far, the last one I've been taking was on American Express. You see that I collected a credit of $1.02. As you can see, the stock went down quite a lot during the pre-market. As you can see, the open, like, it was really quite low. It was, I think it almost like went down to $139 when it had closed previously to $147. And what happened after that is that I closed my call side for a profit, and it was my put side that was in a loss. Because the stock went down so much in pre-market, I basically closed my trade for a small loss. I think it was like a $30 loss. I mean, nothing crazy, nothing bad, but you know, it happens. Now let me show you all of the trades that I've been taking since I think last August, and I want to show you the results because I think it's really interesting. So now we're in this Excel spreadsheet, and it's probably the most boring Excel spreadsheet like you've ever seen, but I think it's quite interesting at least to see the good information. In this column, you have all of the tickers that I've been trading. So it's normal if you start seeing like the same tickers over and over, because this just refers to all of the trades that I've been taking. And then in the other column, you have the results. And then in the result column, you know if it's a winner or if it's a loser. And here I'm not talking about any, for example, type of big profit or small profit. If it's a winner, then it was in the winning category, and if it's a loser, it's in the losing category, regardless of how much I lost, how much I won. And it's really about trying to see how many trades are winners and how many trades are losers. So obviously, without going into all of the trades that I've been taking, I basically, as you can see at the top here, I've taken 38 trades, 38 earning trades in total since last August. So as you can see, and maybe you could think otherwise, like because I talk so much about this strategy, you could think that I take like dozens of trades every day. However, it's not true at all. I have been taking 38 trades since last August, and I won 33 trades of those 38 trades that I've been taking, making a win rate of 86.84%. And that's where it's really interesting to see, because usually when I sell a short strangle, I know that my theoretical probability of profit is usually around 70-75% or something like this. However, you can see that my win rate is a lot higher than this. It's a lot higher than 70-75%. It's actually at 86%. So why is that? And the reason for that is because of the IV crush. When you have a very high implied volatility on a stock, it means that we're expecting a very big move on that stock. And so the probabilities are going to reflect that. If we expect, for example, let's say the SPY to crash tomorrow, then you're going to have very expensive options even though they're super far out the money. And in reality, when we see that actually nothing really happened, nothing more than usual, well, what happens to the options, they all decrease in price instantly. And that's something that I've been talking about a lot on this channel, is this concept of IV crush, implied volatility, and the fact that we actually overprice options. It means that we're basically going to experience more wins if we bet that the stock price is staying within a zone rather than what is actually being predicted on the broker, for example, based on the current implied volatility. And what happens, because we know that the options are overpriced, well, if we know that, well, it means that usually if you bet that the stock is staying within a certain zone, well, you're going to be right, and actually even more often than what it is on the paper. So on the paper, I have a 75% win rate or something like this. In reality, I have an 86% win rate. So should you absolutely go for this strategy and start selling short strangles on each and every stock that have their earnings? Well, no, I don't think so. And there are several reasons for that. The first one is that it's quite a risky strategy, to be honest, meaning that when you sell a call and put at the same time, so yes, you have a very high probability of profit. However, is it a strategy that is going to fit you exactly? Well, I don't know. You need to judge that for yourself, because there is risk with that strategy. When you're wrong and the trade, let's say, just blows past your strike and just goes into complete loss, well, when you're wrong, you're really wrong. Because know that when you sell naked options, that's how we call when you sell just a call like this or just a put, well, your loss is theoretically unlimited, especially for the call side. At least for the put side, can only go to zero the stock, but on the call side, if let's say the stock just triples in value, then you could actually owe money to the broker. And I'm not saying this to scare anyone from using that strategy. I think it's an amazing strategy, and actually that's why I like it and I do it, because it just works. However, I think it's important to be aware of the risk that you're taking, and it's like in anything like this with options. It's way better to go into something knowing what is the worst case scenario, what would you do in that case before doing anything. And there are basically 4 earnings seasons per year. So basically each and every single quarter there's going to be what we call that earnings season that is going to last around 1 month. And personally, I found that there were some great opportunities, and I wanted to share with you what are the trades that I've been taking. And really, I think that the most important thing about this strategy is making sure that the stock doesn't move too much during earnings. And how can you check that? Well, to check that, I use a website called Options Lab. So this is something that I share in my other video where I share how I trade earnings with the whole methodology. Honestly, when I found that, it just blew me away, because that's where it really clicked for me. Because think about it, when you sell a short strangle, you want the stock to stay within your range. So if you go for a stock that usually moves a lot during earnings, you're going to lose money, and actually you're going to lose a lot of money. So that's why you want to use that strategy on stocks that usually don't move too much during earnings. So at least you have all of the best odds on your side. And what I look on that website specifically is called the EVR. The EVR is basically a number from 1 to 10 on their website. The closer to 1, the less volatile is the stock during its earnings, and the closer to 10, the more volatile the stock is during its earnings. So ideally, you want to go for stocks that have very low EVRs. In my case, I like to stick to stocks that have EVRs less than 2. And you could think that an EVR of like 2 is really not a lot, and when you look at the scale from 1 to 10, I could, for example, go for 5 or 6 or something like this. It's true, technically there is nothing preventing you from doing anything. However, you need to be mindful about the risk that you're taking. That's why, for me personally, and that's really only my opinion, I like to stick to stocks that have EVRs less than 2. That works for me, at least. I hope that you found that video interesting, where I share what trades I've been taking recently, which earning trades I like to take, and I hope that it brought you value. If you like this video, just don't hesitate to subscribe to my channel, and let me know if you have any question in the comment section. I'll be happy to answer any question that you might have. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.